Let's talk investing, folks. We're not talking about get-rich-quick schemes. We're talking about building wealth over time. Ever heard of Google? Since its IPO in 2004, Google's stock has skyrocketed. That's the power of long-term investing. Investing is a marathon, not a sprint. It's about patience and discipline. Over the long haul, the market trends upwards. Remember, it's not about timing the market, it's about time in the market. Now, you hear a lot of talk about index funds. And don't get me wrong, they're a solid choice for many investors. They offer instant diversification by spreading your money across a basket of stocks. Think of the S&P 500. It tracks the performance of 500 of the largest publicly traded U.S. companies. Investing in an S&P 500 index fund is like owning a tiny piece of each of those companies. But here's the thing. While index funds provide broad exposure, they won't necessarily make you rich. They're designed to match the market's performance, not outperform it. That's where individual stocks come in. When you buy individual stocks, you're essentially becoming a part owner of that company. You're betting on their specific growth potential, their management team, their products or services. This is where the real excitement lies. The potential to hit it big by picking the next Amazon or Apple. Of course, this requires research, due diligence, and a bit of gut feeling. But hey, fortune favors the bold, right? The stock market is like the ocean, folks, full of waves, currents, and the occasional storm. Short-term market trends are like those waves, constantly ebbing and flowing. They can be influenced by news events, economic data, even tweets. Day traders and short-term speculators try to ride these waves, buying low and selling high in quick succession. But let me tell you, it's a risky game. It's like trying to surf blindfolded. You never know when that big wave is going to crash down on you. Long-term investors, on the other hand, are like seasoned captains. They've weathered countless storms and know that the long-term direction of the market is what matters most. They focus on the horizon, not the choppy waters beneath. Now, that doesn't mean you should completely ignore short-term trends. They can create buying opportunities for savvy investors, but don't let them dictate your entire strategy. Remember, slow and steady wins the race.
One of the most important concepts in investing is the margin of safety. Think of it as a buffer zone, a cushion that protects you from losses. Here's the deal. No matter how much research you do, you can never predict the future with 100% certainty. There's always a chance that things could go wrong, that a company's earnings might disappoint, or that a global pandemic could hit. Remember that. That's why it's crucial to buy stocks at a price that's significantly lower than their intrinsic value, their true worth. This discount is your margin of safety. It limits your downside risk and gives you room for error. Let's look at Palo Alto Networks, a cybersecurity giant. They're a leader in their field with a strong track record of growth. But like any stock, their price can fluctuate. By buying their stock at a discount to their intrinsic value, you create a margin of safety, protecting yourself from potential downturns. Section 5. Unearthing value. Finding diamonds in the rough. Value investing is all about finding those hidden gems, those undervalued companies that the market has overlooked. It's like going bargain hunting at your favorite store. You're looking for quality merchandise at a discounted price. Value investors pore over financial statements, analyze industry trends, and assess management teams to identify companies trading below their intrinsic value. They're looking for businesses with strong fundamentals and a clear path to growth, even if the market hasn't fully recognized their potential yet. Take Cardinal Health, for example. They're a major player in the healthcare distribution and medical supplies industry. Despite their solid performance, their stock has been trading at a relatively low price-to-earnings ratio, indicating potential undervaluation. Value investing requires patience and a contrarian streak. You're going against the herd, betting on companies that others have dismissed. But when those diamonds in the rough finally start to shine, the rewards can be substantial.
Section 6. Growth investing. Identifying companies with exponential potential. Now let's talk growth investing. This strategy is all about finding companies that are poised for explosive growth, those disruptors and innovators that are changing the game. Think Tesla, Amazon, or Netflix in their early days. Growth investors are looking for companies with a unique product or service, a large and growing market opportunity, and a strong competitive advantage. They're not afraid to pay a premium for these high-growth stocks because they believe the potential rewards outweigh the risks. Remember Palo Alto Networks? They're not just a value play, they're also a growth story. The demand for cybersecurity solutions is only increasing, and Palo Alto is well positioned to capitalize on this trend. Growth investing can be volatile, no doubt. These high-growth companies often have high valuations, and their stock prices can swing wildly. But for those who can stomach the ups and downs, the potential for outsized returns is undeniable.
Section 7. Sector rotation. Capitalizing on market cycles. The stock market is like a constantly rotating carousel, with different sectors taking turns in the spotlight. Sector rotation is a strategy that takes advantage of these cycles by shifting investments into sectors that are expected to outperform. Think about it. When the economy is booming, sectors like consumer discretionary, think retailers and restaurants, and technology tend to thrive. But during economic slowdowns, investors flock to defensive sectors like healthcare and utilities, which are less affected by economic cycles. Right now, the industrial sector is looking particularly strong. This sector includes companies involved in manufacturing, construction, and aerospace, all areas that are seeing increased demand as the global economy recovers. By understanding these cyclical trends and identifying which sectors are ripe for growth, you can potentially enhance your returns and mitigate risk. It's like catching the wind in your sails and riding the wave of market momentum. Section 8. Diversification. Don't put all your eggs in one basket. You know the old saying, don't put all your eggs in one basket? Well, it holds true in investing too. Diversification is key to managing risk and protecting your portfolio from major losses. Imagine putting all your money into a single stock, no matter how promising it seems. What happens if that company faces unexpected challenges, a product recall or a scandal? Your entire investment could be wiped out. That's why it's crucial to diversify your holdings across different asset classes: stocks, bonds, real estate, sectors, industries, and even geographies. This spreads your risk and reduces the impact of any single investment on your overall portfolio. Think of it like a balanced diet. You wouldn't eat just one type of food, would you? You need a variety of nutrients to stay healthy. The same principle applies to your investment portfolio.
Section 9. Tools of the trade navigating the market with precision. Navigating the world of investing can seem daunting, like sailing without a compass. But fear not. There are tools to help you make informed decisions. Stock screeners filter stocks based on criteria like industry or financial ratios. Staying informed is crucial. Use financial news and analysis. Portfolio management tools track investments and monitor performance. Risk management tools assess risk tolerance and develop strategies.
Section 10. The power of patience and discipline. We've covered a lot of ground today, folks. From long-term investing and margin of safety to value investing, growth investing, sector rotation, and diversification. But there are two more crucial ingredients for successful investing: patience and discipline. Remember, investing is a marathon, not a sprint. There will be ups and downs, bull markets, and bear markets. The key is to stay the course, stick to your investment plan, and not let your emotions get the best of you. Patience. Don't expect to get rich quick. Building wealth takes time, discipline, and a long-term perspective. Resist the urge to chase after every hot stock tip or panic sell when the market dips. Discipline. Once you've developed a sound investment plan, stick to it. Don't let fear or greed cloud your judgment. Review your portfolio regularly, rebalance as needed, and stay informed about market trends, but avoid making impulsive decisions. Section 11. Your journey to financial success. So there you have it, folks. We've explored the exciting world of investing, covering key strategies, tools, and principles that can help you achieve your financial goals. Remember, investing is a journey, not a destination. Start by defining your financial goals, assessing your risk tolerance, and developing a sound investment plan. Educate yourself about different investment strategies, research companies thoroughly, and don't be afraid to seek advice from financial professionals when needed. Remember, the stock market can be a powerful engine for wealth creation. By embracing a long-term perspective, practicing patience and discipline, and utilizing the tools and strategies we've discussed, you can navigate the market with confidence and set yourself on the path to financial success. Now go out there and make some money.